It was interesting developments yesterday regarding a financial aid package for Greece if it does need to, in fact, look for extra money, and it involves the European Union, it involves the IMF, but we also had ECB President Jean-Claude Trichet coming out yesterday and saying that involving the IMF is a very, very bad thing, and the European Union is not doing enough.
Yeah, it's almost like Greece are walking on the tightrope. They've been handed a balancing stick, and now there's some sort of a net on the bottom should they fall. And that's ultimately what it's all about, because they have to refinance about 20 billion euros worth of debt in the coming months. And the last bond auction that they got it away at something like 6%. So it's becoming increasingly expensive. And this is against the backdrop of them having to cut social spend aggressively. And obviously back home, this hasn't been received too well. And I must be careful what I say here, Eleni, because I know you're Greek and I've got some Greek cousins. I don't want to lose any friends here. But, you know, nobody wants to go into this. And it was evident in France, where the same sort of thing was happening. You know, hundreds of thousands of people taking to the street and just basically saying no. I beg your pardon. But I'm not too sure, you know, if this solves all the issues. It might just solve it from a confidence point of view, but then people will start turning their attention to Portugal, which received a credit downgrade, but seems to have done enough for now. And then the two elephants in the back of the room that nobody wants to talk about is Spain and Italy. So, you know, this is an evolving problem, and I think the ECB needs to come up with a concrete, because everyone uses the same currency ultimately.
Do you think that the IMF should be taking some kind of responsibility here as well? Because that's what Jean-Claude Trichet was also alluding to, the fact that the EU should sort out its own problems. I mean, clearly, this also perhaps just puts a dampener on the capabilities of the European Union and whether it can control its members. We know that some of the data that Greece gave to the European Union weren't exactly true. So that also creates quite a big issue. But I suppose it also just proves that the EU needs to come up again with some kind of mechanism to cope with debt-laden countries, to cope with deficits that get out of control.
Yeah, like you rightly pointed out, lots of lies from all sorts of parties. I think the interesting part here is there's also politics at play here. You must remember in Germany there's an internal election happening in May. So Angela Merkel doesn't want to be seen to using taxpayers' money to bail out a smaller EU country. So maybe they better rethink their political strategy and say we'll have a coordinated political elections all at the same time. So you don't get to this point where your biggest member economically is not able to say anything simply because of fear of losing political ground, where it's an economic issue. And I know the two are completely interlinked, but that's why there's been this reluctance from Germany to lead when they should be at the front of the queue, simply because there are political motives at play here.
Sasha, what do you make of credit default swaps? Because they also had a hand here. We know the likes of Goldman Sachs and the fact that they also just, you know, lied about the fact that they were giving money to Greece and they put it on as a currency trade. And then they sold CDSs and then everything just kind of blew up. But a lot of people made money, and it's all about speculators. We know that hedge funds and derivatives at this stage are under the spotlight. They are trying to regulate the market and trying to make it a little bit more transparent. And at the end of the day, when you look at the value of derivatives in the global economy, I think it's 12 times the global economy, because they're worth $600 trillion. So that is also bringing up and unearthing quite a lot of issues.
Yeah, I think there needs, I think like any sort of engineering, it probably needs to be regulated. I don't have a problem with CDSs. I do have a problem with naked CDSs, i.e. not owning, because you want to own some sort of insurance. It's like me saying to you, okay, well, someone's going to crash your car, but you don't own a car, let's take out insurance on it. Or you're going to take out insurance on Lorata's car and make sure she crashes, you know, that sort of thing. So I think, you know, a naked CDS I do have a problem with, but if you want to insure yourself against default, I think it's a type of financial engineering that makes markets more efficient, ultimately. So what I think people are looking for, and as is the case, once you get these financial engineering, it's often that any sort of legislation is far behind the curve. So I would prefer to see them in a traded market rather than over the counter between parties who specialize in these things specifically.
It's amazing how sovereign issues and sovereign debt has become a really big focus right now, and of course Portugal as well with that credit downgrade. And we had Reserve Bank Governor Jill Marcus yesterday saying that she's also looking at the external factors that could be affecting South Africa. Interesting to note, though, we did have a 50 basis point interest rate cut, bringing the repo rate to 6.5%. That's about 5.5% down from August 2008 on that repo rate. So quite a big move there. But to what extent have all these external factors, got to do with what we'll be seeing in South Africa going forward? Because of course it is a very big risk, and it's a big risk to global growth as well.
I think what people lose sight of is that this was the biggest economic downturn, as many economists will note, since the Great Depression. So this is a once-in-a-lifetime event, and there have been lots of shock factors. So as such, there's been backlash from people who can't quite come to grips with that this is a once-off event, or this was a very harsh event, and it wasn't a normal cyclical recession. It was much deeper than that, and required lots of government aid. So there are angry taxpayers. There are people pointing fingers at everyone from investment banks to speculators to all types. So I think what people need to recognize is that over time, over the next 6 to 18 months, we need to see firmer regulation. But I can bet your bottom dollar that right now there's someone engineering the next financial crisis. It's just a matter of regulators paying more attention.
Consumer-related stocks, of course, doing quite well at this stage on the back of that 50 basis point rate cut. Were you surprised at the move? Because a lot of economists just got it wrong, and no one really knew where we'd be going on this front. Some were a bit more conservative, saying that the inflation outlook doesn't look that great, and the fact that we're only at 5.7%, that means we're only 0.3% in the target band, so that didn't warrant a rate cut. But also interesting to note that the rand had a big role to play in this decision as well.
Much firmer currency, so all your imported inflation, which of course, energy is a big component of that. So I think also because oil prices have been very stable over the last few months gives the MPC a better idea, because it's not about the data that you see yesterday and the day before. It's more about what they're seeing 18 to 24 months down the drag. And many economists, and they're a smart bunch of people, were probably betting that they'd stay pat and maybe look for a couple of extra data points before acting. And I think it's a pretty bold move, and Jill Marcus did say it was unanimous, so there was no disagreement in terms of the panel.
She did say it was a lively debate, though.
She did say it was a lively debate, but ultimately she said it was unanimous. And no one disagreed either way or another. So it's interesting to see that all the members are on the same page, because often if you see ructions inside of the committee, that's not exactly great, and that means you're at some sort of tipping point. Will it be the last? I don't know. I think ultimately it depends on inflation outlook, and if oil prices are going to remain steady and our exports are going to pick up, which they have, and the rand's going to remain firm, well, maybe we'll...
Yeah. I mean, looking at the inflation outlook, they're expecting 4.9% in the third quarter of this year. They're expecting 2.6% growth for 2010. I mean, they're expecting things to look relatively robust this year. But at the end of the day, how is this going to affect the equity markets? Do you think it's going to be a positive? Because some say that although this move had something to do with trying to weaken the rand, it's actually going to have the opposite effect.
Yeah, because ultimately what they want to do is be able to close the differential, the gap. And also in the developed world, interest rates are going to start rising at some point soon. So we're going to get to a point where the interest rate differential is not as juicy for the risk you're taking on by investing in fixed income assets in this country. So maybe the desired effect is somewhat political at the fringes, if I get that's what you're alluding to. Although I don't necessarily think a strong or a weak rand either way. I think business must just cope around that. So on the retailer score, I think a lot of them have run really hard, as have the banks. And a lot of them are just within a whisper of their all-time highs or at all-time highs. So they've done really well this year, and have been the two-star sectors so far.